Okay, we're going to continue on this time with short exercise 14-8 found on page 685 of your text. This is a continuation of the 14-7 exercise we just did in the previous video. And what I want to do now is just run through the various line items on this statement of cash flows, just so you know where things come from. So we always start out our statement of cash flows indirect method with the net income number. And as you know, this is an accrual-based number. And in operating activities, what we're going to aim for is we're going to back out the different accruals and be able to arrive at more or less a cash basis number for net cash provided by operating activities. So let's see how we do that. So we type in the net income number. Then we come down here to the adjustments to reconcile net income to net cash provided by operating activities. The first thing we're going to do is if we have depreciation, depletion, or amortization of intangible assets, we're going to add that number back. The reason being, that's not a cash basis number. That number has served to decrease our net income, but it has nothing to do with cash. So we're going to add back depreciation. The second thing we're going to do is we're going to analyze in our operating activities the changes in current assets and current liabilities. And in your book on page 668, 669, they do a pretty good job, a very good job actually, of explaining what happens when there's an increase or a decrease in current assets and an increase and a decrease in current liabilities and why. And so let's just take the increase in accounts receivable for a second. We know that our accounts receivable went up by $5,500. Let's think about what happens to get that increase. Accounts receivable is increased with a debit, sales are increased with a credit because we've sold something on account, but we don't yet have the cash. Therefore, we're going to subtract out $5,500. Conversely, when we're analyzing our accounts payable, we notice that our accounts payable has gone up $5,000. All right, let's think about what happens there. We've purchased something, an expense or maybe an asset. So we've purchased something on account. So accounts payable goes up, but no cash has come out. Therefore, that has the same effect on cash as adding it back. So you can see now that we're going to take our net income, we're going to add back depreciation and subtract out our increase in accounts receivable, add back our increase in accounts payable, and then you're left with the net cash provided by operating activities of $30,500. And as you can see, we actually generated more cash from our operating activities than we may have thought we did just based on our net income number. The next activity that we're going to look at is investing activities. And we already did the analysis for this in our previous exercise. So we've acquired equipment, right, for cash. Investing activities are anything that takes place in the long-term asset section of our balance sheet. So it's acquiring equipment, if we've sold equipment or investments for cash. Remember, this is all cash-related transactions. So we have here 16.6, right, of equipment acquired for cash. That's going to come out, right? It has the effect of taking cash away of 16.6. So we don't have anything else in our balance sheet in long-term assets. So that's the only investing activity we have. So therefore, the net cash used for investing activities is $16,600. We're now going to move on to the financing activities, right? Anything that is a long-term liability or a change in common stock, or once again, we have to analyze another section here, which is retained earnings. Let's start with what's going on in retained earnings. So here you can see that we've paid cash dividends, but we don't see anything in the data that says that we paid $11,900 in cash dividends. Where did we get that number? Well, the difference in retained earnings is the difference between the $38,900, right, and the $52,400 that we end up with, and that's $13,500. But where does that difference come from? Well, there are two things that affect retained earnings: net income or loss and dividends. So we have to analyze our retained earnings account just like we had to analyze our equipment account and our long-term notes payable account. So you can't just rely on taking the difference between the two numbers and thinking that you're good to go there. So here we started with retained earnings of $38,900. We know we had net income from our income statement of $25,400. And then we end up with $52,400 in retained earnings. Okay. Well, the net income alone is higher than the $13,500 difference. So we had to have paid something out. So the difference solving for X is the $11,900 that we paid for dividends. We went ahead and analyzed the payment of notes payable in our previous exercise. So we know that we paid, so again, coming out of cash for $11,300. Also, in our previous exercise, we had issued $5,300 in notes payable. If we're issuing $5,300 in notes payable for cash, right, that's going to be a debit to cash and a credit to long-term notes payable. So that's going to add to our cash. And then we don't have anything in the common stock, anything in the data that tells us that the common stock is, that there's anything else affecting it besides cash. So therefore, we can just take the difference in the beginning and ending common stock account and the common stock account balances and determine that $5,000 of cash, right? We issued $5,000 in common stock for $5,000 in cash. When we net the $11,900, $11,300, $5,300, and $5,000, we know that we actually used $12,900 for financing activities. What we're looking for when we net out our three activities, operating activities, investing activities, and financing activities, is we're looking for the change in cash. That's our reconciling number. You can see that beginning cash was $3,800 if you look at the balance sheet, and ending cash is $4,800. So it has to be a net cash increase of $1,000, which we have. And we got that from taking $3,500, subtracting out the $16,600, and subtracting out the $12,900. And that becomes our net increase in cash of $1,000. We started again with a balance of $3,800. We add that $1,000 to that, and that's where we end up with $4,800 in our ending cash balance. The reason I really like this statement, that it's my favorite statement out of all of the financial statements, is that it gives me a lot of information. It tells me, if I just looked at the change in cash, I might not be, it doesn't tell me enough. It just says cash went up by $1,000. But if I'm looking at that change in the operating activities, I know that we got $30,500 just from the day-to-day operations, that we ended up spending $16,600 on new equipment, and that we've actually, right, netted out with $12,900 in financing activities. So to me, that gives me a lot more information than just looking at the $1,000 change in cash.